G'day there, Wealth Press subscribers, viewers, traders, and investors. It's time for another Monday morning roundtable, and I'm joined by Adam Sarhan, Jeff Zananiri, Jeff Yasteen, and Roger Scott. Gentlemen, welcome.
Thank you for having us, James.
Morning, James.
Great to have you all here. Now, we're starting this week after a bit of a wild week last week. This week, we're kicking it off with a big gap up in all major indices. I'm going to start with Adam. What's driving the markets today, and where do you see the action this week?
Sure. So what we're seeing today is big relief, a relief rally, if you will. The vaccine started shipping yesterday on Sunday, the 13th of December. So that's a good thing. And all over the world, we've been seeing, at least in the developed world, we've been seeing vaccines roll out slowly and steadily there as well. So the market always looks forward, remember, to the right of the chart, not to the left. And looking forward, this bodes very well for Q1, Q2, and the rest of not just the year, but the rest of life. The faster we can put COVID behind us, the better. So there will be hiccups, obviously. There will be rollout, there will be delays, all that kind of fun stuff. So it's not like this is a magic cure and, pop a pill and you're done. But the good news here is, unlike other vaccines, to my knowledge at least, the mRNA vaccine, which this happens to be one of them, is a vaccine that changes your cells to fight the virus. The other vaccines in the old days used to put a smaller or a weakened amount of the virus, whatever that virus was, into your system to help you just acclimate and whatever the case may be. This one's a little bit different in such that it changes the cells in your body to actually combat the virus without having to put the virus inside of you, which is a big differentiator and a very good thing.
You bet. Jeff Yasteen, do you see this, the exuberance in this morning's market, a product of the vaccine anticipation?
Certainly, and this, as we've been discussing these elements at various points here for months, we're seeing sort of obviously a buildup to this. Is this a climax? No. I think that obviously the market, as Adam was saying, will continue to move higher here, and I think we start worrying about things, some sharper corrections perhaps in January as we get into the new year. That I was looking back at like 2000 as an example, where the market continued moving higher for a number of months, but at the same time we saw a handful of pretty sharp 10-15% corrections in the NASDAQ, and I wouldn't be surprised to see that sort of thing reoccur. But the key is the trend is still pointing higher, and I think it will be pointing higher for quite a while here, as we enjoy this, the second life that the vaccine is starting to give the economy and people and their optimism and hope.
Sure. And Jeff Zananiri, are you agreeing with the general outlook of the group here? And if so, what are you doing to trade by it?
Yeah, so I, as a rule, always kind of wind down in December and try to be de minimis in my activity and my sizing, because it's like the end of a story, right? You don't want to get too crazy at the end of a story because there's a new beginning that's about to start in January. So I'm focusing really a lot of attention as to how we're going to transition from the end of this year to the new year, how they're going to wrap up. I think these indexes are going to go a little bit higher to close the year out with some window dressing on much smaller volume. So I'm literally like unwinding my book, basically closing out my recommendations and everything to get smaller into the year end and have a whole fresh start in 2021. One thing that's interesting to me this morning in particular is the beating that the big IPO stocks from last week took in Airbnb and DoorDash. They're both down double digits right now. So it's a cautionary tale. I was around and I made my bones on the street in the late 90s when this sort of activity was the norm and people got these IPO fever. And we talked about this a lot last week on Wealth Press, that people need to be careful and not just jump in and start chasing these things, because literally like they are the buyer of last resort. A lot of this stuff is getting dumped on the public and people have to be careful and time them. I think they're great companies, but it's a perfect example of how, you really need to be careful in your timing, your position entry. A bad entry into a position will almost guarantee that you not make money.
Right. Yes, choosing your moments carefully. Roger, what's the outlook from where you sit for this week?
Well, I'm very cautious right now. I'm really cautious because, as Jeff said, we're closing the year, and we can see a lot of hanky panky, especially with lack of institutional trading and a lot of exuberant retail money. Momentum levels still bother the heck out of me. We're at an 11-year high right now. And I don't want to be all doom and gloom. I don't think we're going to have a crash anytime soon, but I think the markets are a little overbought. I think we're going to definitely see a major catalyst change for 2021 as the new administration takes place. I do believe that technology, the top large capitalized tech stocks may be a little bit overbought in comparison to other sectors. I think we're going to see upside from others, and large tech will be limited. Most importantly, I want to see the data that's coming out this week. I think this week is going to be very telling because we have a retail sales report. And correct me if I'm wrong, but I think this may be the last retail report before the end of this year. And if that's the case, it's going to be very telling because it's going to generate a lot of knowledge about what happened in Black Friday and Cyber Monday. So that report, believe it or not, but that one report has a lot of influence of how this year goes. Because if the retail report is going to tell us that the numbers slowed down temporarily in November and then sped up again, that's going to be really, really positive. If not, that's going to be very, very negative. And I'm afraid that may happen. Number two, we have jobless claims. Last week, jobless claims were substantially higher. And I mean substantially higher. We went completely in the other direction. And the expectation this week is awful. Either way we go, we're not even looking at below 700 now. So if we're going to go above 900,000 again, I hate to say it, but it's going to be a question of how fast these vaccines can permeate throughout the society in order for us to go back. And my fear is, and this is what I've been fearful of, that unfortunately the biggest impact of the vaccine is not going to be felt till the end of the first quarter of 2021. And if that's the case, we're going to potentially see a nice little correction before we go up again. Now, again, I'm not predicting a bear market, but I'm very wary of all these factors. And what I'm afraid of is the negative news is going to catch up to us before the positive news begins to uplift this market. And I think the retail data and the jobless claims this week is going to be extremely telling of that fact.
Mm-hmm. Okay. So then let me ask this of the group. To what extent do you think that the hope placed in the vaccine to drive a broad economic recovery is a little bit premature and perhaps a little bit misplaced, in that we're not really going to get much penetration of the vaccine into the population generally until more like Q3 2021. And the vaccine also, remember, does not prevent you from spreading it if you've been exposed to it, nor does it prevent you from, well, I can't remember what else I was getting at with that. But anyways, the vaccine is limited in its ability to transform people's sort of status against it in the near term. So do you think that's going to induce a lot of reckless behavior, which might actually catalyze more of a spike and pressure on hospitals? And again, Adam, I'm going to start with you.
Sure. So I think the answer is going to be a wait and see. If we get another vaccine, Moderna is supposed to release theirs soon. If a few other guys, AstraZeneca as well, might have one in the pipeline. So if we start getting multiple vaccines, that may help reduce the length of time it'll take for the population to get vaccinated, if you will. But yes, everything in life comes down to risk and reward, and especially in the market. So when you have behavior, human behavior, which is all that matters here, on Main Street or Wall Street, it comes down to risk and reward. So if there's a perception that it's safer to go out and about and live your life back to normal, you're going to see a ton of activity without the masks, the traveling, the this, the that, whatever needs to get done that people did before COVID, assuming that things are going to be okay, even though they're not okay just yet. So that could definitely lead to another spike or another wave, or if this wave continues, elongates this wave before we get back to quote unquote a safe environment. But from my standpoint, from trading, this week we have the Fed, and we've got the Fed still remains the biggest elephant in the room, if you will. And the Fed just happens to flood the system with liquidity. Other central banks are doing it as well. 2020 has been a record year for central bank money printing. And to be honest, the market is focused on that. Eventually, like the game of musical chairs, the music's going to end, and this will end. Hopefully it ends okay. It's not a bad ending, but nobody knows. This is a big unprecedented experiment with global central bank money printing. So for me, yes, that could lead to more activity. To directly answer your question, that could lead to more cases. But to me, the big juggernaut, or the big elephant in the room, is how are the markets going to react to easy money from the Fed and other central banks going forward into the first half of next year. The Fed's made it very clear they want to keep the easy money pedal to the metal, if you will. And that so far, the markets have been reacting very well to that. But like Roger mentioned earlier, you're starting this, and Jeff Yassine as well, and Jeff Z, you're starting to see signs of froth, which has happened in 99, it happened in 1929, and it happened many other times after these big, long, decade-plus bull moves. We technically had a 2-week bear market in March of 2020 for COVID, but you've really been rallying more or less since 2009, since March of 09. And this has been a very long bull market. It's long because of that central bank money printing. So for me, eventually this will end. The Jeff Z IPOs that you just mentioned, Dash and Airbnb, even you've got other ones as well, PLTR, that have come out. Some of them have been good, some of them have not been good. But you really have to ask yourself, are we early in the cycle or are we late? And are you buying things that are low risk, or are you buying things that are high risk? So as long as the market keeps reacting well to the Fed, okay, that you have to respect that, because the price action at the end of the day trumps everything else. But once that relationship stops, just blindly buy, be very, 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 very careful.
Right. Okay. And Jeff Yassine, do you see the premature sort of exuberance fueled by the vaccine as a risk or a opportunity, or both, for the immediate future?
Yeah, obviously it always presents a risk, and yes, is there some degree of over optimism out there given the limitations of the vaccine, and as Adam was saying, or Roger was saying, it's not a magic pill, and it's going to take a while for it to have its true impact on the U.S. and global population. Yes, in my view, we're seeing some of that in certain areas, like. I've been a proponent of buying airlines and the cruise ship stocks for months. And in that time, they've moved up 30, 40%. Oil stocks too. A lot of them have had really good moves. Is there a degree of over-optimism in cruise and airline stocks? Yes, especially in cruise ship stocks now. And I said a week or two ago in a video, you should be selling these into the strength, because as we saw, I think Carnival said they're not going to start doing another, cruise line voyages in North America until I think March or April or May. So, there's still a lot further to wait before you see real revenue begin on that side. And to a lesser degree, we'll see that in the same thing with the airlines. So the way I see it is, I think you just need to keep looking at where there is not as much optimism, and it hasn't gotten to a fully frothy point yet. And obviously there's a lot of subjectivity with all that. I still see energy, and I still see banks as areas that you can look at. Industrial elements, you can look at those in the stay-at-home stocks and a lot of the more obvious areas. I think those are fully valued. And like I said, other areas that have already had really good runs up to this point, and I don't see much in terms of comparisons for the next, say, handful of quarters compared to the quarters past, that they're going to be good comparisons. To me, that's the key thing you need to be looking at.
Sure. And Jeff Z, I know that you're winding down your exposure at the end of the year as per your habit, but do you see that the vaccine exuberance exists as any kind of threat or opportunity from your perspective?
I mean, there's exuberance in everything. Try to go buy some wood. I just did a new deck. It was insane. I'm trying to buy a refrigerator. You're going to wait 2 months. Try to buy a watch. You're going to have to buy one on the secondary market. There's exuberance in everything. People are hoarding. They're buying stuff. They're trying to convert what they perceive to be a deteriorating asset, cash, into anything. And so they're paying different degrees of premium for that conversion. But I don't think it's any kind of, and Adam touched on it, I don't think there's any kind of coincidence that there's, a Bitcoin explosion on the upside at the same time as there's an IPO craze at the same time as all of these things are happening. So pick your flavor. People are paying up. Do I think it's ahead? They've gotten ahead of themselves in terms of the crisis going away? Absolutely. But as Adam said, the big game in town really is liquidity and the Fed and money printing and this like giant financial alchemy experiment that we're conducting right now. And no one really knows how it ends. None of us do, because we don't really have, we've never been in the situation that we're in right now. I mean, where would the stock market be if we didn't have COVID in 2020? What would be fair value for the S&P 500 if we didn't have it? So people, it sometimes it pays to have like a radical thought and say, would we be 30% higher? Would we be 30% lower? Nobody knows. So when you get into this kind of carnival atmosphere in terms of asset pricing, how much is an IPO worth? Bankers at Goldman Sachs thought Airbnb should be 100% lower than the first day aftermarket buyers thought. I don't know. There's a lot of air in that. There's a lot of air in that tire is what I'm saying. So you have to proceed with caution when you're in this type of scenario, because intrinsic value and market value have never been wider in my estimation than they are right now.
Sure. Okay, that's an interesting concept, Roger. So then sort of consolidate that for us, if you will. Reconcile this idea that the vaccine is perhaps inducing a little bit premature exuberance, yet you can't ignore the fact that the Fed is active and nobody can fight the Fed, and the Fed is determined to continue to stimulate, even though it doesn't look like there's going to be any agreement between the prevailing forces of the U.S. government anytime soon to arrive at a stimulus package before Christmas. So what is our correct posture then?
Look, there is a huge disconnect between the economy and the stock market. And the last few words that Jeff said were exact. I was just going absolutely right. If you're looking for value and momentum, if you're looking for value, this is not the stock market to be in. This is a momentum-driven market. Look at Warren Buffett's performance and look at where he stopped outperforming the broad market, and that's where the market stopped being a value market. Okay, this is a momentum-driven market. There is a huge disconnect between intrinsic value and price. Doesn't mean the market's going to go down. We've been in this market environment for a long time, and it may be the new norm. I don't know, and we won't know. We won't know for a long time, and it doesn't matter. That's the biggest thing. You are still going to have sector rotation. You're still going to have stocks that are going to be going up. You're still going to have overvalued and undervalued. It's just a matter of where we're at. So I think the best way to do this is not to throw the baby out with the bathwater. I think the best way to deal with this is to be prudent. For example, if you look at the NASDAQ 100, we are at the highest momentum level in 11 years, okay? We at a highest objectively. I'm not giving you my opinion. I'm looking at the number of stocks trading above a certain number, and we're at the highest level in 11 years as of this morning. That's not good. We're also diverging over a long term between the RSI and the price action. We are not doing that in the Russell 2000. The Russell 2000 has been beaten down over the past few years. So in my opinion right now, the value is going into lower price stocks or stocks that are not tech heavy. For example, let me give you a really good example. A few months ago, we knew that somehow these COVID vaccines will have to get to the hospitals. Over this weekend, FedEx was holding a big box showing the stock is up, I think 3%, 4% at the open, and it has much more upside. So we move into a different direction. We know that home sales, everything relating to homes, home repair, home construction, home refinance is big. We know that when people buy homes and when they do homework, we know that they buy mattresses. It's a very common thing. People buy mattresses when they do stuff to their home. I have a mattress stock right now that's making a raging new high. JD Power, 52 highest rated stock, making a good low risk entry. The point is, you've got to seek value in any kind of market environment, and there's always value. Emerging markets are breaking out for the first time. So it's not about whether it's not a binary question whether the markets are overbought or not. It's about where we could still find an edge and where we could find value. And the beauty of the global economy and the global market, there's always price, always time to, there's always a chance to find that edge. Sorry for confusing everyone, but there's always opportunity. There's always opportunity at any given time. And believe it or not, as we have seen by being here for many months now, the markets are not nearly as efficient as a lot of professional traders want us to believe, because if they were, we wouldn't be able to predict these multi-month trends that we have seen. And we have seen and predicted some multi-month trends. So I think it's a matter of just stepping back, changing your focus from large cap tech to seeing where the value is and still finding momentum. The general rule that I would follow is buy stocks that are trading above the 200 and the 50-day moving average. Sell stocks that are trading below the 200-day moving average and have been trading. If you look at large energy stocks, if you look at the airline stocks, if you look at the cruise ship stocks on a long-term time frame, the majority of their trading action over the last year has been below the 200-day moving average. So those stocks, you want to sell strength. If on the other hand, you look at stocks like FedEx, for example, those stocks have been ultra strong. Those stocks you want to buy pullbacks. So there's always opportunities. It's just a matter of finding the right opportunity in the right market cycle.
All right, gentlemen, we're going to leave it there for now today. Thank you very much for joining us. We'll come back to you next week, and we'll see you then. Thank you for joining.